Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Datavault AI.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine for a second that you could take thousands of tons of physical copper.
Right, just buried hundreds of feet underground.
Exactly, buried in some remote mine. And without digging a single hole, you somehow turn that metal into a liquid asset that you can just, trade on your phone in a matter of seconds.
I mean, it sounds like science fiction, but that is exactly the scenario we're unpacking today.
Yeah, and for anyone managing a portfolio right now, you have likely seen the massive volume spikes surrounding this stock recently.
Oh, absolutely. It's been everywhere.
We are looking at a company that's attempting this really fundamental, aggressive pivot from just being a traditional data firm into what they're calling a real-world asset tokenization powerhouse.
Right. And that phrase, real-world asset tokenization, or RWA, that's the central mechanism you really need to understand to evaluate this play.
Which is kind of our mission today, right?
Yeah.
To dissect whether this whole strategy of tying digital assets directly to physical commodities actually creates, genuine asymmetric upside for your portfolio.
Yeah, or on the flip side, if the underlying financial maneuvering and, frankly, the dilution risks just make this a massive value trap.
Right. Because to make that determination, we have to look at the immediate catalyst driving all this crazy volume.
We really do.
We need to start with the promise of what this technology can actually do before we get into the brutal reality of what it costs to build it.
Exactly. And the market-moving event here, it happened on March 31st, 2026.
Right, the Coppercore deal.
Yeah, Datavault AI announced a definitive agreement with Coppercore to tokenize their high-grade copper resources.
Which is wild.
It is.
Yeah.
The initial program is targeting the minting of $100 million, or maybe even more, in what they're calling Coppercoin digital tokens.
Okay, let's slow down there and look at the mechanism because, the traditional commodity model is inherently slow, right? And just incredibly capital intensive.
Oh, totally. It's an absolute grind.
Like if you own a copper reserve, it is essentially trapped value. You cannot easily borrow against it or trade it until you finance the heavy machinery, physically extract the ore, refine it, and then finally ship it to a buyer.
And that illiquidity, that is the exact friction this whole initiative targets.
It's the bottleneck.
Right. So by transforming those in-ground physical assets into highly liquid digital instruments, they are creating this scalable, high-margin revenue model.
And completely abandoning their old business in the process, right? The traditional consulting and software licensing.
Yeah, they're leaving that completely in the rearview mirror.
But look, anytime you introduce a digital coin into a portfolio, the immediate concern is volatility. The crypto space is notorious for assets that just swing wildly based on, nothing but social media sentiment.
Oh, absolutely. A single tweet can tank a token.
Right. So if you are tying an industrial metal to a token, how does this act as a hedge? Doesn't it just add more risk to the equation?
Well, it comes down to a concept they call the vertical integration of trust.
Okay, break that down for us.
So in traditional decentralized finance, a token's value is often derived entirely from network consensus, right? Basically, how many people are willing to buy it on any given Tuesday.
Just pure supply and demand based on hype.
Exactly. But Coppercoin operates on a fundamentally different mechanic. One token corresponds directly to a specific physical quantity of the metal.
So it's pegged to reality.
Right. Think of it as a digital warehouse receipt for, say, 5 tons of copper.
So the token obviously has a physical anchor in the real world.
Yes, a tangible, auditable anchor. And the pricing of that token is directly linked to COMEX benchmarks.
Which is the primary futures market for metals, for those who might not follow commodities that closely.
Right. So if the global industrial demand for 5 pounds of copper pushes the market price higher, the intrinsic baseline value of your token rises in lockstep.
Okay, so you are holding a digital asset that you can trade on a weekend, but its price floor is established by heavy industry, not internet hype.
You nailed it. That's exactly the value proposition.
Well, look, if minting $100 million in copper-backed tokens is such a brilliant high-margin business model, we have to look at the defensive moat.
Oh, the moat is everything here.
Right, because what stops a massive trillion-dollar tech conglomerate from just spinning up their own blockchain tomorrow and executing this exact same playbook?
That's the billion-dollar question. And the barrier to entry here is actually deeply rooted in intellectual property.
Okay, so they have patents.
Yes.
Yeah.
Most companies trying to enter the tokenization space, they rely on third-party white label solutions. They just rent the underlying architecture.
Which means anyone else could rent it too.
Exactly. But Datavault AI actually owns it. They hold specific patented blockchain platforms known as IDE, Datascore, and DataValue.
Okay, walk us through how those platforms actually function in sequence. Like, how does owning that specific software pipeline prevent a partner from just jumping ship?
Well, it creates immense switching costs. So the process begins with auditing the physical asset in the ground using the IDE platform.
Okay, step one is the audit.
Right. Then the Datascore platform evaluates that physical asset against market metrics to assign a verifiable value.
Making sure it's actually worth what they say it's worth.
Exactly. And finally, the data value platform mints the actual token.
Okay, as I see.
So when a partner like Coppercore builds their entire liquidity infrastructure, their digital bridge from the dirt to the market, essentially on those specific patented platforms, they become totally locked into the ecosystem.
Because they can't take that process with them.
Right. They cannot just unplug and move to a competitor without completely rebuilding their auditing and minting infrastructure from absolute scratch.
Okay, I understand the moat when we are talking about physical metals. But looking at the recent developments, there is a strategic pivot that honestly seems incredibly disjointed to me.
You're talking about the sports deal.
Yeah, the company just launched a name, image, and likeness, or NIL platform, with the boxing star Moses Itama.
It's definitely a wild pivot.
Right, going from in-ground copper reserves to a boxer's endorsement rights. I mean, from an investment standpoint, that looks like a company spreading itself dangerously thin across completely unrelated industries.
It certainly appears disconnected on the surface, I'll give you that.
Mm-hmm.
But if you look at the underlying mechanics, it actually proves the flexibility of their technology.
How so?
Well, the underlying asset itself, whether it is a ton of copper, a silver mine, or a boxer's future endorsement revenue, it really does not matter to the software.
Yeah, but valuing a human being's brand trajectory is fundamentally different from pricing an industrial metal on the COMEX. You have to admit that.
The end product and the market are different, yes. But the actual process of bringing that asset to the blockchain is identical.
Okay, I'm listening.
Think about it. A boxer's future earnings are inherently illiquid, just like unmined copper. The athlete cannot spend the endorsement money they might make 3 years from now today.
Right, they have to wait for the contracts to pay out over time.
Exactly. So Datavault AI uses the exact same data score and data value mechanics to audit the historical revenue of the boxer, score the projected value of those NIL rights, and then mint a token.
Oh, wow. Okay, so that token allows fans or institutional investors to basically buy a liquid share of that future revenue today.
That's exactly it.
Man, that reframes the business model significantly. I mean, they're not trying to be a mining company, and they're not trying to be a sports promoter.
Nope, neither of those.
They are essentially building a universal toll road. They provide the infrastructure to turn illiquid assets into liquid ones, and they just collect a fee at the toll booth regardless of what cargo is driving on the road.
That is the exact business model. It's a perfect analogy. And, it beginning to show up in the financials, too.
Because of all these new pipelines.
Right. Driven by these diverse partnerships, management recently raised its 2025 revenue outlook to $40 million.
Wow. 40 million.
Yeah, and for a small-cap growth firm, securing that level of forward revenue visibility, that is a massive milestone.
It is. However, and this is a big however, building and scaling a universal toll road across multiple billion-dollar industries requires an astronomical amount of capital.
It really does. It's not cheap.
Which brings us to the core problem, and honestly, the biggest glaring risk factor for anyone holding this stock today. We need to talk about the financial war chest and the brutal reality of shareholder dilution.
Yeah, we have to objectively weigh the bear case here because the capital requirements are severe.
Very severe.
On March 20, 2026, the company filed a prospectus to offer up to $1 billion in securities.
Look, if you are holding this stock right now, that $1 billion figure should make you sit up straight in your chair.
It's a massive number.
For a small-cap firm, a shelf offering of that magnitude sounds terrifying. To visualize this for you, think of the company's total value as a pizza. You own a slice.
A classic analogy.
Right. When a company issues massive amounts of new shares to raise $1 billion, they are basically cutting that same pizza into millions of tiny microscopic pieces. Your slice suddenly represents a much, much smaller fraction of the company.
And that's the dilution reality.
Exactly. So is this a strategic necessity, or is it a massive red flag for impending cash burn?
Well, the market viewed it with extreme caution, and rightfully so.
Mm-hmm.
It acts as a necessary war chest, but the dilution risk to your portfolio is undeniably real.
Right.
Now, to be fair, a shelf offering does not mean they are just dumping $1 billion in shares onto the market tomorrow morning. It is a legal mechanism,
Okay, so it's more like a credit line.
basically.
Wow.
It gives management the authorization to quickly draw down funds from the public markets over time as they actually need it.
Okay, but what exactly requires $1 billion in operational capital right now? That's still a huge number.
Rapid aggressive expansion. I mean, they previously announced a $2.15 billion mineral tokenization partnership with ASMI.
The gold and silver one, right?
Yes, specifically targeting gold and silver. You need massive capital to ingest and process $2 billion worth of precious metals into a digital ecosystem.
That makes sense.
But beyond that, they just announced a definitive agreement to acquire NYIAX.
Wait, NYIAX, they operate in the advertising technology space.
They do.
Are you telling me they are applying this tokenization model to digital ad inventory now?
That is exactly the strategy. Think of digital ad space as a highly volatile, perishable commodity.
I mean, I guess it is.
Right. A premium digital billboard slot is incredibly valuable right before a major event like the Super Bowl, but it's worthless after the event passes.
Yeah, the value goes to zero instantly.
Exactly. So by using their platforms to tokenize that ad space, advertisers and publishers can trade ad slots on a secondary market, locking in liquidity just like they would trade copper futures.
Okay, theoretically that's brilliant, but taking on precious metals, sports, NIL rights, and a complex ad tech acquisition simultaneously,
It's a lot to juggle.
it requires flawless execution. If management stumbles on any of these fronts, they will be forced to tap into that billion-dollar shelf offering just to keep the lights on.
And that instantly dilutes the retail investor.
Right, which is exactly what people are afraid of.
And the broader market recognized that exact risk. Just look at the price action on March 19th, immediately following the fourth quarter results and that initial NYIAX acquisition announcement.
The stock dropped significantly, right?
Severely.
Yeah.
Investors saw the operational weight of the NYIAX integration. They anticipated the impending capital requirements, and there was immediate profit-taking.
So the market really punished them for the complexity.
Yes, it is the clearest proof that while the RWA narrative is incredibly promising, institutional money is not giving this management team a blank check.
No, the market demands proof of concept,
Exactly.
which honestly makes the recent technical actions so compelling. I mean, the market punished them on March 19th, but the turnaround since then has been violent.
It really has.
So how are institutional and retail investors actually pricing the promise of this tech against the reality of that dilution risk right now?
Well, the technical chart right now reveals a textbook catalyst-driven breakout.
Okay, let's look at the chart.
That March 19th dip, it actually served a purpose. It established a hard, undeniable support level where all the sellers essentially exhausted themselves.
Right, the bottom fell out, but then it held.
Exactly. And then came the March 31st announcement regarding the $100 million Coppercoin program.
And the stock gapped up and violently breached the resistance levels.
It did. And more importantly, the volume profile spiked, and they actually remained elevated. The stock landed on multiple most active stocks lists.
Which isn't just retail traders playing around.
No, not at all. When you see buying pressure completely overwhelm sellers right at the open, and the stock sustains that volume across multiple trading sessions, that signals serious institutional accumulation.
So the big players are getting in?
Larger funds are actively rebalancing their portfolios to gain exposure to the tokenization narrative, and they are using this stock as the vehicle.
It is fascinating to contrast that aggressive buying behavior with the current analyst coverage, though.
Yeah, the analyst notes are interesting.
We have notes from Jack Vander Aarde over at Maxim Group. He is maintaining a buy rating on the stock, but he recently adjusted his price target down from $4 to $3.
And that adjustment tells you exactly how Wall Street is modeling the future here.
How so?
Well, by maintaining the buy rating, he is confirming that the patented technological moat and that massive jump to a $40 million revenue outlook justify upside from current trading levels.
Right, he still likes the core business.
Exactly. But lowering the target to $3 means he is running the math on that $1 billion prospectus.
Ah, he is factoring in the bigger pie with the smaller slices.
Yes. He assumes they will have to dilute the shares to fund the NYIAX integration and the Coppercoin rollout.
And that means management's margin for error is absolute zero. They need to generate cash flow quickly to avoid tapping that shelf offering too heavily.
Which puts a massive, massive microscope on the catalyst calendar.
Because timing is everything in a setup like this, let's map out the critical horizons for the listener.
Yeah.
The data shows the Coppercoin launch is targeted for the end of the second quarter 2026. And shortly before that, their first quarter earnings report hits in late May or early June.
And those dates are colliding with massive macro tailwinds that we just cannot ignore.
Yeah.
I mean, ask yourself, why are they starting with copper instead of gold?
Because of the demand.
Exactly. Because the baseline physical asset is experiencing a historic surge in global demand.
Right. Driven primarily by the massive build-out of artificial intelligence data centers and, just the broader push for global electrification.
Artificial intelligence requires unimaginable amounts of compute power.
It does.
And that compute power requires sprawling new data centers, which require thousands of miles of physical copper wiring to handle the power load and the cooling systems.
Wow. So Datavault AI is stepping in to make the asset digitally liquid at the exact moment global industry is scrambling to secure physical supply.
It's a perfect storm.
So to summarize the trading setup for you, if you are looking at managing this position, this is essentially a high-stakes, buy the rumor, hold for the execution scenario.
That's the exact playbook.
You have the Q2 launch date, the earnings report acting as a preliminary checkpoint, and the macro demand for copper all converging within the next 90 days.
And that Q2 deadline is the critical horizon. They have broadcast the $100 million Coppercoin issuance to the street.
Right. Everybody knows it's coming.
Right. So the failure to execute a flawless launch by the end of that quarter could result in a sharp downward correction because the current institutional buying pressure has already priced in the success of that rollout.
Man, we've covered a tremendous amount of ground today, navigating the shift from physical dirt to digital toll roads, and that massive billion-dollar balancing act management is currently executing.
It's a very complex play.
It is time for the final thesis summary. The verdict gives the stock an 8 out of 10 bullish score.
Which is a formidable rating, mostly grounded in the strength of those proprietary patents we discussed.
Definitely. The elevator pitch for your portfolio. Datavault AI offers genuine asymmetric upside as it capitalizes on the intersection of two massive, unavoidable global trends, AI infrastructure demand and blockchain liquidity.
Right. They have effectively pivoted away from their legacy data model to establish a truly defensible moat in the tokenization space.
And for the strategic play based on this analysis, it shapes up as a swing trade targeting a 3-month hold.
Yes. The strategy requires holding through that critical Q2 2026 Coppercoin launch while keeping a close eye on an exit near the analyst consensus target of $3.
It is an aggressive play, balancing incredible tech with serious capital risks.
It really is. And, it leaves us with a staggering question when you consider the broader implications of this technology. If Datavault AI successfully proves that it can take physical, in-ground copper and make it instantly liquid to fund the global AI infrastructure boom, what other highly illiquid real-world assets could suddenly become tradable overnight, completely disrupting traditional commodity markets as we know them?